If gold can go from $20 an ounce to $2,600 an ounce, it can go from $2,600 to $26,000 or to $100,000, right? I mean, there's no limit because, again, gold's not changing. All we're doing is decreasing the value of the dollar. And they could print them, they could drop trillions of dollars out of helicopters, right? What stops them, right? So, I mean, how much is the price of gold in Zimbabwe? Anybody know? How many trillions of Zimbabwe dollars do you need to buy an ounce of gold? But, at one point, the Zimbabwe dollar and the US dollar were 1-to-1. I forget when, but I think that was the case for a while. It's just that normally in a bull market, you would expect the gold stocks to lead the metal, that they would anticipate higher gold prices. And so they would incorporate that into the price, into the PE multiples. But what's been interesting or unique about this bull market is that the gold mining stocks have lagged and they constantly have to catch up. Gold will go up and make a new high, and the gold stocks will eventually go up. Gold will have a small correction. Maybe gold drops 50, 100 bucks. Gold stocks will get killed by 10%, maybe 20%. Then gold will make a new high, and gold stocks will start to come back up, and then it keeps making new high, new high, new high, and then eventually the gold stocks make a new high, and then gold has a correction, and the gold stocks get killed again. And so they're really having a hard time outperforming gold like you would expect them to do, and I think that's because nobody believes this bull market. They've been bearish the whole way. It's been climbing the mother of all walls of worry. I think that is going to change. I mean, you look at the big gold stocks like the Barrick and the Newmonts, they're trading at discounts, sharp discounts to the S&P 500. They historically traded premium. And so they're cheap. The gold companies are priced to book. They're historically low. So there's a lot of bargain here. And I think that we're going to start to see the gold stocks coming in with some big earnings beats. Third quarter, I think this quarter, and especially Q4, which we'll get those numbers in next year. But I think we're going to see big beats. These major companies are going to be announcing increases in dividends. They're going to increase share buybacks. Then you're going to start to see some consolidation, more acquisitions. The market is eventually going to really go up. And, one of the problems that the gold stocks have had is that they've been an ironic victim of inflation. And it's ironic because you would think that they would benefit from inflation. But inflation drove up the cost of mining, but the price of gold didn't go up commensurate with that. Even though it's gone up a lot, mining costs have gone up even more. And I think that that's changing. I think you're going to see gold going up a lot more than the cost of mining it. In fact, if you look at oil today, oil's at an all-time record low priced in gold. You can get almost 40 barrels of oil for an ounce of gold. That's great for gold mining companies. And the wages now are not, running because they're not, the US dollar has not been that weak. Normally you have a weak dollar relative to other currencies in a gold bull market, but we've had gold moving up with the dollar, stable to firmer. Although it's been weakening recently, it hasn't really gotten killed. The DXY is still above 100. And so you wouldn't have thought that we'd have $2,600 gold with a dollar index still above 100, but we do. But that's great for the gold mining companies because their wages are not in dollars. So I think they're going to really start to make up for the lost ground. And Wall Street is completely off guard. Nobody really is following this sector. In fact, earlier this year, back in February, March, several of the brokerage firms downgraded Newmont, downgraded Barrick to basically sells when gold was just about 2,000. And those stocks hit multi-year lows. Earlier this year, you had multi-year lows in the largest gold mining companies. I mean, I took advantage of that. I was buying more myself, even though I already owned a lot. I couldn't, help it. I had to buy more because I wasn't going to, let that gift, just go away. And I was pounding the table on my podcast back then, telling people you got to buy these stocks when Wall Street is giving them away because they're basically capitulating. And I remember when they downgraded, was it Barrick? The analyst said, "I'm downgrading it because I don't see any upside potential in gold. Gold's at 2,000. It's fully priced. It's not going to go up. So why buy a gold stock when gold can't go up?" And of course, then gold had its best year probably since that guy's been alive. You're talking about 6-7 times increase from here, and we're 2,600 or from 2,000, let's say. So a six-fold increase from 2,000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold.
When discussing the value of gold and silver, it's crucial to highlight their historical significance as stores of value. In times of economic uncertainty, such as the one we're facing today, investors and even entire nations have turned to these metals to safeguard their wealth. Gold and silver have outlasted every fiat currency in existence, providing a tangible refuge when inflation, political turmoil, or declining trust in paper currencies erode purchasing power. Let's dive into why gold mining stocks, which have historically led the price of gold, have been trailing in this current bull market and why this could present an enormous opportunity. Traditionally, in a bull market for gold, gold mining stocks outperform the metal itself. These stocks tend to anticipate higher gold prices, reflecting that expectation in their price-to-earnings, PE ratios. In a strong gold market, investors expect these companies to benefit from higher gold prices, increasing their revenues and profits. However, this time around, we are witnessing a significant divergence. The stocks of gold mining companies like Barrick Gold and Newmont Mining have been lagging behind the price of gold, even as the metal has hit new highs. What we've seen so far is a pattern where gold stocks experience substantial sell-offs during minor corrections in the price of gold, only to play catch-up later when gold resumes its upward trajectory. Gold will make a new high, but the stocks will remain suppressed only to rebound later. This is highly unusual. Historically, gold stocks have led the charge, often reflecting the market's expectations of future gold prices before the metal itself rises. The primary reason is that the broader market is skeptical of this bull run in gold. Investors remain wary, expecting the rally to be short-lived. They are not pricing in a sustained bull market. This wall of worry has kept gold stocks undervalued, even as gold itself continues to climb higher. But this skepticism may soon turn into an opportunity. As the market begins to accept that we are in the early stages of a long-term gold bull market, gold stocks are likely to explode higher as they play catch-up. If you look at the valuations of major gold mining companies, you'll find they are trading at a significant discount compared to the broader stock market. Historically, gold mining stocks traded at premiums to the S&P 500 because they were seen as safe havens in times of inflation or market volatility. Yet today, companies like Barrick Gold and Newmont Mining are priced to book at historically low levels, offering investors a unique buying opportunity. Wall Street analysts seem completely out of touch with the reality of gold's rising prices. Earlier this year, some brokerage firms downgraded major gold stocks, citing limited upside due to the expectation that gold had already reached its peak. Ironically, gold has had its best year since those downgrades, demonstrating that Wall Street has fundamentally misunderstood this bull market. As Peter Schiff said, this is an opportunity for investors to buy gold stocks at bargain prices. The reluctance of Wall Street to recognize the long-term value of gold mining companies presents a significant opportunity for savvy investors who are willing to go against the grain. One of the most ironic aspects of this bull market in gold is how inflation, normally a tailwind for gold stocks, has initially acted as a headwind. Inflation has driven up mining costs across the board, from labor to energy, which has squeezed profit margins for gold mining companies, despite rising gold prices. However, this dynamic is beginning to shift. While the costs of mining have increased, the price of oil, a major input cost for gold mining, is currently near all-time lows when priced in gold. You can now buy nearly 40 barrels of oil with a single ounce of gold, a stark contrast to historical norms. This is excellent news for gold miners because it means their costs, particularly energy costs, are relatively low, while the price of gold continues to rise. As gold prices climb, the profit margins for gold miners will expand significantly, and this will start showing up in their earnings reports. This is precisely why investors should expect to see significant earnings beats in the coming quarters for the major gold mining companies. With lower costs and higher gold prices, these companies will also likely increase their dividends, initiate share buybacks, and even consider acquisitions as they capitalize on their growing profitability.
And the wages now are not, running because they're not, the US dollar has not been that weak. Normally you have a weak dollar relative to other currencies in a gold bull market, but we've had gold moving up with the dollar, stable to firmer. Although it's been weakening recently, it hasn't really gotten killed. The DXY is still above 100. Gold is telling you that interest rates are too low. They should be higher. The Fed should be hiking, not cutting.
Right.
That's why gold is making a new record high every week. And it's going a lot higher as the Fed continues down the wrong path. And they're talking about that inflation is gone. It's not gone at all. It's going to reemerge stronger than ever. Not that it ever disappeared. Inflation never got back down to the Fed's so-called 2% target. We're about 3% the way the government measures it, which means we're like 6% the way consumers pay it, because the real prices probably rise twice as fast as what the government will admit in the CPI. But that said, the CPI is finished going down, and now it's headed back up. We got up to 9% was the high year over year, and we've been banging around 3% for the last year or so. That's kind of like the bottom. And I think we're trending back up. And by 2025, we can easily be back up at 9% again, year over year, maybe higher.
I want to go to that point you made about everybody's funding our deficits on the international side. What changes that? Because the reality is so much of that is just because of the industrial military complex, bases everywhere. When you have guns and you've got the military stationed in countries like Germany, it seems that it's hard to really back away from funding the U.S. government when they're your defense.
I mean, that's true. I mean, we're all over the world. We've got our troops all over the world, but, we can't afford to deploy them. We can't afford to provision them without borrowing money. That is not sustainable. It's going to crumble. And I don't think the world is going to pay an ever-increasing tribute to the United States to maintain this situation. I think it's going to come to an end. Yes, it's gone on for a long time. Our military has been part of what's probably enabled it. But then again, we still have to pay for a lot of that military, and it's very expensive. We're broke, so, we can't really afford it. Gold was in a bear market from 1981 until 2001. So it had a 20-year bear market where it went from 850 down to 250 approximately. Then it had another bull market where it went from 250 up to 1900. And that bull market peaked in 2011, and it really lasted just 10 years. So that was the initial breakout from the bear market. Then we pulled back and we had a consolidation where we went from 1900 down to about 1000 in 2015, then back up to 2000 in 2020. But we pretty much stayed between 1700 and 1900 for a few years. We didn't really break considerably above 2000, get to 2100 until this year. And so now I think we've just started the next bull market, the next leg up, which I think will be at least proportionate to the first leg, which was, the 250 to 1900. But that's a huge increase in the price of gold. You're talking about 6-7 times increase from here. And, we're at 2,600 or from 2,000, let's say. So a six-fold increase from 2,000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold. And, if gold can go from $20 an ounce to $2,600 an ounce, it can go from 2,600 to 26,000 or to 100,000, right? I mean, there's no limit because, again, gold's not changing. All we're doing is decreasing the value of the dollar. And they could print them, they could drop trillions of dollars out of helicopters, right? What stops them, right? So, I mean, how much is the price of gold in Zimbabwe? Anybody know? How many trillions of Zimbabwe dollars do you need to buy an ounce of gold? But, at one point, the Zimbabwe dollar and the US dollar were 1-to-1.
Yeah.
I forget when, but I think that was the case for a while.
To truly appreciate the role of gold and silver in today's economic landscape, it's vital to recognize the broader context of the U.S. national debt and the growing risks associated with it. As Peter Schiff and many other financial experts have pointed out, the U.S. government is on an unsustainable fiscal path, with debt levels ballooning past $36 trillion. This isn't just an abstract number, it's a ticking time bomb that could reshape the global financial system. What does this mean for investors, and how does it affect the future of gold and silver? Let's dive into the dynamics of this debt crisis, how it impacts the US dollar, and why it makes gold and silver indispensable assets for the future. One of the fundamental problems facing the US government is that it continually borrows money to finance its massive budget deficits. Year after year, the government spends more than it collects in taxes, and it covers the difference by issuing treasury bonds. For decades, foreign governments, particularly China and Japan, have been the primary buyers of these bonds, effectively lending money to the U.S. in exchange for interest payments. However, this dynamic is changing. Foreign demand for U.S. debt is declining. China, once the largest holder of U.S. treasuries, has been quietly reducing its exposure. Japan, too, has been scaling back its purchases. This leaves a gaping hole in the market for U.S. debt, one that must be filled either by domestic buyers or, more dangerously, by the Federal Reserve itself through quantitative easing, i.e., printing money to buy government bonds. As Schiff highlights, this creates a debt trap. If the government cannot find enough buyers for its debt, it will either have to raise interest rates to attract more buyers, which would increase the cost of borrowing and slow economic growth, or rely on the Fed to continue buying bonds. Both options are disastrous in the long term. Raising interest rates could trigger a recession, as higher borrowing costs would stifle investment and consumer spending. On the other hand, relying on the Fed to print money would lead to runaway inflation, eroding the value of the dollar, and making it increasingly difficult for Americans to afford basic goods and services. The US dollar has long been the world's reserve currency, meaning that it is widely used in international trade and held by central banks as part of their foreign exchange reserves. This status has given the US a unique advantage, the ability to borrow cheaply and spend freely without immediate consequences. However, this privilege is not guaranteed to last forever. As more and more foreign governments lose faith in the US government's ability to manage its debt, they are looking for alternatives to the dollar. China and Russia in particular have been advocating for a shift away from the dollar in global trade. They have been accumulating gold as part of a broader strategy to diversify their reserves and reduce their reliance on the US financial system. In fact, central banks around the world have been increasing their gold reserves at a record pace, recognizing that gold is a safer, more stable store of value than the dollar. This shift away from the dollar is one of the primary reasons why gold prices have been steadily climbing. As foreign governments move out of US treasuries and into gold, they are signaling a broader loss of confidence in the dollar and the US economy. Schiff has often pointed out that the US is living on borrowed time. The dollar's dominance has been sustained largely by inertia and the lack of a clear alternative. But as more countries seek to reduce their exposure to the dollar, its value will inevitably decline. This will drive up the price of gold even further, as gold is seen as the ultimate hedge against currency devaluation. One of the reasons the US has been able to maintain its global dominance for so long is its vast military-industrial complex. With military bases around the world and a defense budget larger than the next 10 countries combined, the US has used its military might to exert influence and protect its economic interests. But maintaining this global military presence is incredibly expensive, and it contributes significantly to the national debt. The US government is essentially borrowing money to fund its military operations, and as Schiff notes, this is not sustainable in the long run. At some point, the rest of the world is going to tire of funding the US government's deficits. When that happens, the US will no longer be able to borrow at low interest rates, and it will be forced to either cut military spending or print more money to cover the costs. Either way, the result will be the same: a weaker dollar and higher gold prices. Inflation is often referred to as a hidden tax because it erodes the purchasing power of your money without you realizing it. In the current environment, inflation is far from under control, despite what the Federal Reserve would have you believe. While the Fed claims that inflation is hovering around 2 to 3%, the real inflation rate, the rate at which the cost of living is rising for ordinary Americans, is much higher. The Consumer Price Index, CPI, the government's official measure of inflation, has been widely criticized for understating the true cost of living. Many economists, including Schiff, argue that the real rate of inflation is closer to 6 to 7%, if not higher. This means that your dollars are losing value at a much faster rate than the government is willing to admit. As inflation continues to rise, the value of hard assets like gold and silver becomes even more apparent. Unlike paper currencies, which can be printed at will, gold and silver have intrinsic value. They are finite resources that cannot be easily manipulated by governments or central banks. This makes them ideal hedges against inflation. In fact, if inflation continues to rise at its current pace, we could see hyperinflation, a scenario in which the value of the dollar collapses and prices skyrocket. In such a situation, gold and silver would become even more valuable, as they would be the only forms of money that retain their purchasing power.